So actually back in 2015, I bought some index funds. Didn't really know what I was doing though, and then I pivoted into crypto in 2016 and the rest is somewhat history. But yeah, crypto is a different market. This is why I've diversified. Going from those days of putting $2,000 into some cryptocurrencies and then making pretty much $250,000 very, very quickly, it kind of skewed my brain a little bit. But yeah, I do have the video receipts on my other channel. That's one thing that I learned. Momentum is key, and also so is risk. But if I was starting again as an investor, especially in the UK market, this is exactly what I'd be thinking about doing because I've done it for over a decade now and it kind of makes more sense to outline it now. First things we need to talk about, and I have talked about this before on the channel, and if you are new around here, feel free to hit that like button and subscribe if you want more content like this. Now, my focus for this channel is all about dividends. It's all about getting my dividend portfolio high enough and grow it. And then other elements around that will be pretty much personal finance. Now, the one thing that I think every single investor does not do, and I'm going to say it, we do not have a safety net. We do not have that emergency fund. So you need to have at least 3 to 6 months of expenses, easy access cash just sitting there, just in case shit goes wrong. You do not want to have loads of cash. You want to invest cash, but you want to have something just in case the wheels fall off your car. Put it that way. And again, we could talk about the high interest element around certain things, around obviously mortgage rates and loan interest and stuff. But saving is always a bit weak if you got loads of cash. This is why you invest it. But ultimately, as I say, you need to have some cash just in case things go wrong. And to mitigate the kind of the problem of I'm never going to do that, set up an automated standing order. Set it up so you've always got money going into a certain pot and it's going to grow. Likewise, when you automate it into the next bit, you're going to find out why that's important, because having everything automated makes life so much easier. Let's talk about automation. Automation into a stocks and shares ISA is probably one of the first and obvious things to do because that is tax-free monies. You can do it with the likes of Monzo, which you may well bank with. There's a link below to this if you're interested. You get some free monies if you open an account. Pretty much simple. But automate your life. Put it in. So if you, I don't know, divvy up all your money and you've got some money left over, put it into a stocks and shares ISA. You do not have to worry too much. And a lot of these, by the way, self-managed. They're all pick whatever profile. So, for example, with Monzo, very, very simple. You can just pick whatever and you just go with whatever. Now, another one on the screen is called Invest Engine. Now, this is important as well because ultimately with this, it's managed. There's a lot of elements around this where you can have manage or DIY. But as you can imagine, automation into here would be pretty key. And the whole point of this is zero capital gains tax, zero dividend tax if you are utilizing the situation around a stocks and shares ISA. Now with Invest Engine, you get up to £100 as a welcome bonus. And yes, when you invest up to £100, you get that. However, capital is at risk and terms and conditions do apply, of course. However, if you want to keep it super simple and you're a total beginner and you go, oh my God, realistically, as I say, you can set it up as a managed kind of situation where you can pick any fund. There's millions on here. It's brilliant. But they are pretty low, especially if you're going on the Invest Engine ones, which there's quite a few of them, but you can go with other providers on the actual platform. Each fund has a different fee, makes it super simple. So moving on to the next bit, which is, again, we're kind of following on a little bit, is having some core ETFs or some smart managed funds available, right? So whether you want to split up your portfolio to maybe 50, 60% of these and then have a couple of individual stocks or whatever you want to have, it makes life easier, especially if you're a beginner, because they all have different risk profiles. They're all catered for different people and they are managed. Yes, there's a fee involved, but ultimately they'll manage it for you, which is easier. So stuff like this just makes it so much easier. When you click on it, you can get the whole information about the fees. You can see the performance and you can also see the breakdown of what stocks are in what, which makes life so much easier. Now, if you want to go and do it a bit more yourself, there's a website called Just ETF. And you can pick your own individual ones. So say if you're in a Trading 212 account, you can pick whatever picks your boat on that and then go and do more research on the likes of Just ETF and you can find out more information. So for example, the FTSE All World here, which is probably pretty common for a lot of people, which you've probably heard of, it gives you all the information in terms of the fund size, where you can buy it or what the ticker is, their overall performance, their overall fees and all that kind of good stuff, and the volatility all on here and what they're actually holding is a bit more of a bigger detail. But as I say, everyone has a different opinion around a fund. You could have, as I say, 50% in management funds. You can have a couple of percentages in these. You can have your own individual satellite bucket list of random stocks that you may want to have. It's entirely up to you. But ultimately, realistically, you want to have, if you're a brand new investor, people do the work for you because that's where they make their money. And ultimately, more often than not, having that element of a bucket of everything reduces the volatility. It makes it so much easier. Because one of the things that does happen, especially if you're a new investor, you shit yourself. You do. You're like, oh my God, we're having a really bad month. I'm losing my money. Ah, shit. Whereas people, especially in the UK, they navigate quite quickly. I want to just put it in savings and earn my 2% or whatever. Yeah, you can get probably triple, maybe quadruple the returns in the stock market. Now, another good point that will probably help you massively if you're a beginner investor is actually have some dividends. Learn how to get paid for investing and focus on the growth and the quality of the business more than the fattest yield. That's kind of the obvious. And I talk about that a lot on my channel. Now, while you're building, you want to reinvest those dividends, and later in life, they will eventually become income. The longer you do it, the more obvious this is. And as I say, like if you want to have a couple of stocks that have dividends, or as you can see on the screen here, a fund that has a decent dividend yield, it makes sense. So this is a random one. This is quite a popular one. Has quite a low yield versus some of them, but a 3.03% isn't too bad. But the overall performance is actually pretty good here. So it's one of those, and the volatility is quite low. You know, it depends on you, obviously, as a beginner investor. But certainly, if I was starting again, I would love to have some income just to kind of showcase that I am making some genuine income and redistribute that. Because if you are thinking, I want to go down the fund side, you need to have some dividends in there. And sometimes you will look at certain funds and you go, wow, the performance is good, but the yield is terrible. Sometimes you can have a mixture of both. You can have one with decent yield and good performance, or you can have some with great performance and very low yield. It depends on obviously what sector. But yeah, you need to do it the right way. And I see far too many people, especially as a beginner, and I've been there myself, they'll go for the obvious stock, which is like, oh my God, 13%. Yeah, the performance is nosediving though. Now, if you are also in the UK, it's entirely up to you what you want to do here, but you also have an element called a pension, a self investment personal pension, a SIP, right? Now, this is an interesting one because obviously, if you're obviously working, your employer can match this at work, and you can do certain things around this as an investor for your own self, and you can make some money. Now, if you're using a personal pension, which obviously on the screen here, now there's obviously situations around this. It's entirely up to you. There is a link below if you are interested in pension. This is what I use. Obviously, the fees are different on every platform, but you get a thing called a 20% relief at source. Higher additional income tax brackets all kind of qualify for different things as well. But you can put £60,000 into a self investment pension fund, right? Which is fine. But the problem you have is you do get taxed on this at the other end. So this is why I have this situation why I have an ISA and I also have this. You have both, in my opinion, anyways. That's my personal thought on it. Because you can only get so much tax free on this. And then when you draw off it at the age of probably 90 by the time we retire, you're going to have your issue where you can't actually get to it. So having a SIP and having an ISA is key because the ISA, as I've said before in previous videos, guess what? You can withdraw that at any point. You are totally at whatever the hell. So that's my whole point of my videos. I want to look at mine at when I'm 50 and go, I can retire a lot early if I so wish to. And then with this, for example, it'll probably be about at the age of 60 pretty much by the time it gets released. So that's going to be hugely important. But as I say, you can get it in different ways. And yeah, you get 20% at source. That builds up, builds up, builds up. And then ultimately, yes, you do get taxed on the other side, but ultimately you can save on your tax if you're self-employed and stuff like that. And not to mention, your employer can match it. Now, again, if you like to invest and you want a little bit of risk, let's do a bit of a crossover. What about cryptocurrency? Now, I've mentioned before, I've been an investor since 2016 in crypto, and I count myself as incredibly fortunate to be literally financially free because of Bitcoin. And I know that's quite arrogant to say, but this whole channel is a bit of a fun challenge and a personal documentation of me doing dividends and also talking about personal finance because I'm doing it anyways. So it kind of makes sense. So if you've got 5-10% of your overall wealth in something a bit more speculative, you're not going to blow yourself up by having that 5-10%. Too many people go all in on crypto. or they go all in on a very, very, silly kind of fund or something daft to try and make money quickly. The reality is there's no such thing as get rich quick. You can lose it quite quickly too. So there's nothing wrong with dollar cost averaging to something like Bitcoin. Realistically, it's self custody more importantly. And if you understand the risk and you understand the volatility, actually you look at the Bitcoin price and you zoom out, it's actually not too bad. But as I say, can you handle the volatility? But realistically as well, Bitcoin does follow the equity markets pretty closely nowadays, so it's not too bad. Now, the one thing about all of that, what I've just said, there's one thing that will make you fail completely: consistency. You need to be consistent. You need to, as I say, going back to one of the first points, is automate it. Automate where your savings go for your emergency fund, automate where your money goes every single time, and treat it like a bill. So if you've got so much going into your funds, cool. If you've got so much going into crypto, cool. If you've got so much going into whatever, cool. It doesn't matter. Long as it's all kind of mapped out for you, because those percentage terms and how much you can then live off, and then you have any sort of windfalls or any sort of tax rebates or bonuses, you can split that up later down the line. The rules always beat motivation. But ultimately, one thing that you need more than anything is momentum and understanding that I am getting paid for my dividends. I am getting return on my investments. I am making money, because that is how wealth is created. It's not so much by, you know, doing it. Sometimes it's about time and consistency, and being able to showcase that over the course of the period of time. You will start to see the results, and then that motivation will continue. It's like going to the gym, isn't it? If you start losing weight, you get more and more motivated to go back. It's the exact same situation with obviously investing. The only downside to this is don't get FOMO, because you may want to over invest because you're making money in a cyclical month. And the final point that you need to remember: don't forget to rebalance, don't forget to review it, don't forget to keep an eye on things, because people just set and forget and off you go. That could be a problem. You can always rebalance every single year. You can move things around. If crypto, for example, goes into a better market, you can kind of hold off until it starts to bottom out. Likewise with your funds, you may be in a very, very tech heavy fund, for example, and you may want to remove that a little bit, remove it around, and always keep an eye on fees, especially if you're in management funds, because they may change them. That might be an issue, especially with likes of, investment funds such as pensions, or even your stocks and shares ISAs. You may find in a management fund on Invest Engine, they may well change the fund. So just make sure you're keeping an eye on it. So yeah, the two things you need to really focus on: have yourself, as I say, stocks and shares ISA. If you want to have a self-investment pension and start thinking about that, you don't have to start that straight away. But ultimately, if you're going to get tax relief, you might as well do it and put money in there. Personal opinion, not financial advice: have two, because you have the freedom and the flexibility of one with an ISA, which is tax-free anyways. But then again, with the pension, you cannot withdraw that. You cannot do anything with it until you hit certain ages. And that age is fucking whatever it could be. It could change realistically. So we need to be mindful of that. By the way, an additional option is obviously the lifetime ISA. I don't do it personally. I don't really understand it too much because I've never really looked into it. But there is an option there if you're under the age of 40. Just start off slow. Remember a management fund. Remember the core element around ETFs to keep it super simple. Automate the compounding on it. Automate your payments into it. And if you get dividends, as I say, always reinvest them. Behavior beats tactics. It does. Automate, avoid tinkering, and don't chase whatever pumped last week. Now, if you enjoyed this video, please do leave a like. It means an awful lot. And comment what you think. What are you doing? So yeah, this is kind of what I would be doing. As I say, tax wrappers first, core funds, realistically, have a bit of dividends in there. If you want to have a little bit of a small crypto sleeve, or even a really, really volatile fund as a small percentage, go for it, because you don't know what the innovation could be. It could be AI funds, it could be certain funds around obviously robotics or whatever, I don't know. And be relentless with your automation. Get it all done. Have your budget set up, have wherever what goes what, and then you're sorted. You don't have to worry about it. And yeah, stick it on the fridge or whatever. I don't know. Just have a rule plan somewhere where you can always see it and always monitor the performance. Do you want more details about what I do? There's a video here, and hopefully it helps.